Welcome to Investing in Startups. I'm Joe Mager. Our guest this week is Courtney McCrea, co-founder and managing partner of Recast Capital. Courtney and I dove into the intricacies of investing in emerging managers and building their firms. We talked about why Courtney is so enthusiastic about emerging managers, the challenges they face and how to overcome them, how LPs can better evaluate emerging managers, and why LPs aren't racing to adopt AI as fast as their emerging manager VCs are. We covered a lot of ground here, and Courtney is super thoughtful. I really enjoyed this one. Hope you do as well. Courtney, thanks for coming on the show.
Hi, Joe. Thanks for having me.
Well, you were saying beforehand, we know a lot of the same people. You're invested with some folks who've been on the show. We're mutual friends with Daniel Dart, so I'm glad we're making this happen.
Yes, me too.
I thought a fun place to start would be to talk about why you're so into emerging managers, not just as an investor, but investing your time in supporting emerging managers and why that you made that such an important aspect of your career.
Yeah, no, happy to do it. I mean, for 10 plus years, I was investing in brand name firms, and we always had an open door for emerging managers. And through those relationships, I realized that institutional investors needed thoughtful, diversified exposure to emerging managers in order to get the returns people are trying to get from their venture portfolio. You're never going to be more aligned with a venture capital manager than when they're raising their fund one or their fund two. It doesn't matter how much of a GP commit they put in. You are directly aligned with a emerging manager. Normally, they're raising right-sized funds that also helps to drive out performance. And they're scrappy and hungry and well-networked with entrepreneurs. They're not fat and happy yet, like many of the brand name venture funds. So we really believe that investing in emerging managers drives out performance if properly selected. It also is a pathway to get access to the brand name firms of tomorrow because it's constantly changing. And one of the things that both my partner and I found at our respective fund of funds we were at previously is you're always trying to be helpful to managers, even when you can't invest for your own portfolio construction purposes. And so my partner, Sarah, came up with the idea of productizing your value add. So especially emerging managers usually have incredible deep domain expertise coming from industry. And that's what makes them so powerful in getting access to really great companies. And yet they haven't raised a venture fund before. And the mechanics of running a venture firm are just different than, running a business or, writing code. And so for those of us that have been on the LP side for a long time, we've seen a lot of decks. We've seen a lot of pitches. And it's a formula in so many ways. And so we just wanted to impart our wisdom as well as the wisdom of our friends from both the GP and the LP community to just talk to emerging managers about how to make your fundraising process more effective and more efficient and maybe less lonely.
I've seen some VCs who did later stage, stick their toes in the water with early stage, and they can be a little like, oh, this water's pretty cold. I don't know how deep this is. And they get antsy and they feel outside their comfort zone. For you, what was the transition like going from household name firms, well-established, to kind of going much earlier? What were your versions of like, oh, this is different. This is a little spicier?
I was fortunate that I was working with two people that have been investing in venture funds since the 70s and 80s. And so really thoughtful about how to diligence managers. The diligence on an emerging manager is so much different than a brand name fund. A brand name fund, you can look at attribution by general partner. You can look at performance. You could look at who's been driving the performance historically. Are they still actively involved and have economics in the fund going forward? You can talk to IR teams. You can get lots of information to, compare funds against one another. When you're talking about emerging managers, the diligence and the underwriting it's a different process. When we backed Aiden Sudcut as a solo GP, he, was an early employee at Google, ran international. He had an incredible pedigree in terms of his background. And then he had an angel track record that we could sink our teeth into. You could look at the quality of the co-investors, whether or not you like the portfolio. You can figure out how he's acting and behaving online and in sort of the air game, if you will, of venture. And we were able to gain conviction that he was a good bet. And that's just one example. And you have to do a lot more reference checking. You have to do a lot more, maybe even background checks, depending on where somebody came from. to make sure that they're going to be good fiduciaries and they're going to be a good steward of institutional capital. But it's a lot more fun and a lot more interesting to do that kind of work, in my opinion, than to do, the analyzing of a brand name that no one's going to fire you for committing to.
Mm. Well, as someone who did public markets early in their career and now does early stage, I can relate to that. It's been a pretty tough environment for emerging managers to get funded over the last few years. I think it's 3 straight years that the amount of money that's gone into overall venture funds has gone down, and emerging managers' share of that has probably fallen as a percentage of the total. So it's been pretty tough, particularly if you're not spinning out of a well-known firm. I've read a different point of view of yours on how to think about, the glass half full with the challenge of emerging managers raising and it being difficult, and particularly women and underrepresented GPs, because it takes them much longer than white males to raise a fund. The glass half full is that surviving the process and making it successfully through points to or leads to a lot of resilience. And I'm curious to hear more about that.
First of all, I think that investors dramatically underestimate the risk of a spin out of a brand name venture fund. I'd make that point first. So when somebody leaves a brand name firm, whether or not they have attribution, you don't know if they got access to these great companies because of what we call the magic cape, the brand name of the firm, or if it really was that general partner. Unless you're an investor in that brand name firm and you have an inside track, you don't know the real reasons why that general partner left that firm. And most general partners, most individuals at big firms are not involved with fundraising at all. If they do, it's tangential. They're used to having an incredible back office and deep resources within the institution. And it's very different to know if they can actually run a firm, run a fund, and be a good decision maker for what companies to invest in. Because in a big firm, there's a lot of other people weighing into the decision. So that's my first point I want to make. The second point I want to make is, I like to say, unless you are, one of these massive raising multi-billion-dollar venture funds, you don't need to be all things to all people. You just need to find the investors who are interested in what you're doing and how you're building your franchise. And so it's never a great fundraising time for emerging managers. Even back when it was the go-go days, a lot of the brand name venture funds took all the air out of the room and took out most of the allocations that LPs had. And so you always have to be scrappy. You always have to be trying to find LPs that other people haven't found. It's very hard to separate yourself from all the other emerging managers when you're reaching out to the exact same LPs. It's very hard to stand out. It's not impossible, but it's very hard. If instead you can find folks that other people haven't called on or haven't reached out to, you can often have better success. And so part of the advice that we give the emerging managers that we work with is if you want to start with the Fortune 500 list, start at the bottom. Don't start at the top. The top people are being called all the time. People at the bottom aren't, and they still have adequate capital, right? And so, find folks that are off the beaten path. And do not start developing relationships with the big brand name public pensions or endowments and foundations that have to write $20 million checks into venture funds and they can't be more than 5%. It's just not a good use of your time, and your pitch is only going to get better with time, and your deck is only going to get better with time. So give it a minute and don't waste your time or their time, trying to have those conversations prematurely.
I want to go back to something you said earlier about reference calls. I've listened to a couple of podcasts with fund of funds managers who have touted making something like 50 reference calls for each investment. And I'm sure that plays well with LPs. But when I hear that as a potential partner, I have a couple of thoughts. Like, one is it takes 50 reference calls to build conviction in what I'm doing. And two is, do you really learn something from call 50 that you didn't learn from call 5? And I'm curious, how you think about that and how you find that equilibrium of doing enough digging and reference calls and diligence, but at the same time, knowing when to take your foot off the gas with that process and just move ahead.
So my experience in backing brand name firms has taught me a lot of lessons about not overreaching. Ideally, you're not doing any reference calls until you know that it's confirmatory and you've got the capital and you are going to be making a commitment. These are just confirmatory reference calls. And so there are the behind the scenes calls, and then there are the on list references calls. And so when I meet with a manager, and let's say that I'm interested in what they're doing, I will create a list of why I like the fund. What do I like about the person and the firm and their strategy? And then I'll create another list of what I think the risks are. And there are always risks in every single fund. And so then the secret is to try and focus on the things that are going to kill the deal. What is going to cause me not to want to invest? What is giving me pause or concern? And focus your energy on those points, because if time is our most valuable resource, and if you can find the fatal flaw fast, it'll save everyone a lot of pain. It's sort of like it's easier to break up with someone on date 2 or date 3 than it is after 6 months. And so the same thing is true with investing in funds. So the most I've ever done of reference calls was a fund 1. This is at my last firm. It was a fund 1, and we were putting them in business. And we were recommending them to other LPs to put them in business. And I counted, and we did 33 reference calls. And yet, in hindsight, we didn't make the one reference call that would have really made a difference. So so much of it has to do with making the right reference calls. It's not the quantity, it's the quality. And so I like to look for confirmatory references. So if you've told me what your secret sauce is to get into companies, or how you add value to your companies, or you've given me some impression that your secret sauce is X, I'm going to want to hear that from your CEOs. If you have a very large portfolio of 300 companies or 100 companies, it's logical to me that not every company is going to sing your praises. You just can't possibly have deep relationships with all 300 companies. But if you tell me these are the 10 companies that I've added a lot of value to and I've spent a lot of time with, and they're my biggest positions, I'm going to want to talk to 2 or 3 of those just to make sure that what you've articulated to me is in their eyes as well. Sometimes it is a reference call. It's not what they say, it's how they say it. So I've had reference calls, and this is more with brand name firms, where I ask them about someone who's on their board that I'm doing the reference on. Their tone is very monotone, not very lively. And so I don't know if this person who I've never talked to before, that's just their personality, or if they feel meh about the person I want them to talk about. So then I will always ask, I'll say, well, you also have such and such on your board. How do they compare to the individual that I'm referencing? And if he then comes out of his skin in a favorable way, that's a real sign that he doesn't feel as positive about the person I'm doing the reference call on. So sometimes it's very subtle. It's not the words, it's the tone, or, how do they add value? Why do you like that individual on your cap table? And can you give me an example? And when they can't give me a real example that you can really sink your teeth into, it's a sign that there might not be as much there. And I'm not saying that everybody we back says that they add incredible value to companies, but many do. And so to the extent that I can't get your CEOs to say that to me in some way can be a yellow flag. And then sometimes people are not willing to say something negative, and yet that they have the ability to say something negative. And so then you ask for other references that you could call in order to get somebody to say on the record something critical. But I would say that usually I'm doing, depending on the fund, a couple of references off list, from people that I know in the network that I've seen are co-investors with you or that are in the same space you're investing in, people that we know well enough that there's one brand name venture manager who we backed at my last firm, and he's in the healthcare space. And if he's highly critical of other venture capitalists, so if he gives a neutral recommendation, that's a raving. That's a really positive sign. So you also need to know the GP well enough to calibrate, are they always up and to the right, or are they very critical? So you can get some sense as to, whether or not they really mean it when they like a manager. And then try and we do online research to, see what kind of an actor you are, especially in early stage venture, how you behave on Twitter and how you behave on LinkedIn. You don't have to be on those platforms, but if you are, how are you showing up and what type of a community member are you? And does that dovetail into your strategy and who you say you are and what you want to invest in? It all needs to flow together. And then when I'm doing on-list references, I want to talk to a couple CEOs that did well. I want to talk ideally to, if you have a company that went sideways or was a write-off, it'd be great to be able to talk to one of them. How did you behave during that process? And then ideally it would be an LP or two, but I'm not doing 50 reference calls on the managers that we are backing out of Recast.
Well, there's so much art to that. That was great. I will probably grip some of that for my own reference purposes. I listened to an interview you did last year where you talked about putting together pods of emerging managers going through Recast. And I loved that premise and what you were talking about. I'd love to hear more about that and how that has maybe evolved as it's gone along.
We were very fortunate to hire Ava Almazor from Kaufman Fellows Program. And she had been at Kaufman running sort of the nuts and bolts of running events for Kaufman. And she brought with her a lot of those lessons that she's learned. And so my partner, Sarah, when I was a Kaufman Fellow, we didn't do this. I was one of 13 fellows in class 3. And so we knew each other really, really, really well. We almost were a pod of our own. Kaufman they don't call them pods, they call them something else. But Ava puts a lot of work into creating pods that she thinks are going to work well together. It could be that they are raising a similar stage fund or similar size funds, or they are more advanced or they're less sophisticated when it comes to being a venture capitalist and trying to make a like-minded group of GPs. She will sit in on the very first call just to get the lay of the land. They all make a commitment to one another on the frequency of how often they're going to get together with one another, and the commitment to each other that they will honor that time and continue to show respect for the people in their pods. And then we're not involved at all. They're on their own. And so we have found that these pods are incredibly helpful. It's a lonely business being an emerging manager in venture. We talked about this earlier that, all the solo GPs in Austin all know each other, and it's sort of like a therapy group.
We're a club.
It's a club. So it's not dissimilar to that. And so it might start with talking about what fund admin do you like, or do you like your legal counsel? I'm looking to change legal counsel. But it very quickly will start to move into other aspects. And you start talking about how to, this is a full-time job. I'm working 24 hours, 7 days a week, and I can't manage my family at the same time as I'm doing this. What tools have other people used? Or, I'm going through a divorce with my co-founder of my fund. Does anybody have? So it becomes a real trusted network. My partner, Sarah, still gets together with her pod from Kaufman. So it's a really powerful, we found with the emerging manager community, 1 + 1 = 3. And it keeps showing, what you put in comes back in spades.
You've looked at thousands of decks and followed a lot of journeys from emerging managers over time. Something I've wondered about is whether there's a common thing that I hear as a solo GP of like, well, what happens if you get hit by a bus? And you mentioned divorce between co-founding GPs. I would love to know if there's a data source or if you have like an anecdotal sense of how often do you see, which is more likely, a solo GP genuinely getting hit by a bus in a figurative sense where it's like, look, can't continue on for whatever external reason. It has nothing to do with performance, but just some extenuating factor that's called hit by bus risk in action. Or co-founding GPs just have a falling out and there's a divorce.
So there's nothing official, but I will tell you anecdotally, over the last 5 years, it is so much more likely that two partners that have just come together get a divorce. We've worked with almost 160 managers. We've seen it in that community. It's just so hard to graft two people on to each other and have it stick. And it could be something that is, we had one situation, two women were partnered together, and one of them decided she needed to spend time with her mother, who was having very serious health issues. The other partner said, I don't want to be a solo GP. The secret of this partnership was the two of us. And so as a result, they're not in business anymore. So sometimes it's not that you don't get along, it's some other factor hits your firm that you can't control. But I think the risks are much higher that a partnership breaks up than that a manager, I used to say hit by a bus, and I think it needs to be changed in the venture industry to, they crash their plane learning to fly. I know too many venture capitalists that have become pilots, but I do think that Back when we invested in Mike Maples as a solo GP, that was the first time my partners had ever backed a solo GP. And this is back in 2009. We analyzed this. We said, what is the reason why we always said there have to be 3 GPs? And we said, well, number one, somebody gets hit by a bus, the other 2 managers can manage out the fund. Number 2, better decision-making with 3 GPs. Basically, they then really thought through each of those. They said, well, the reality is most of these early stage managers, these big brand name firms, have one moneymaker. And if that moneymaker dies, the LPA reads that the other people who are not great investors get to keep investing and keep managing out the fund. So that isn't helpful. Number 2, better decision making. The reality is a lot of these firms, they're siloed. And so I'm making all the AI investments. You don't know anything about AI. You're doing all the enterprise tech investments. And so I have my checkbook and you have your checkbook. So that doesn't fall into place. And so with Mike Maples, we did put into place we really were worried about this hit by a bus concept. And he, by the way, is alive and well and doing just fine.
And doing great.
But that first fund, we actually had a contract where his father, who was a very senior executive at Microsoft, would take over the portfolio, manage out the portfolio, and there would be no new investments. He would just make follow-on investment decisions. So now we don't do that anymore, but I do feel right now today much more confident in backing solo GPs than I do partnerships.
I'm going to hit you up for some advice for my own fundraise. So for Fund 1, I was in market for 18 months, and I found that probably a third to 40% of the money I raised was in the first month. And then another third to 40 was in month 18. And in hindsight, those middle 16 months felt very much like I was wandering in the desert. And I know some of that set up the money that came in month 18. And I guess for folks who don't know, 18 months is the average amount of time emerging managers spend. So it felt like a very long time. And I guess it was, but it's normal. When I look ahead and I think about running that process again, I can't help but think that should be a much tighter process in the future. And even if I'm leaving some money on the table with the gap between month 1 and the final month being much tighter, that I'd be saner for it and able to spend more time when investing. Curious if you have any thoughts or advice on that, and just not really for me specifically, but more broadly, how to think about how long a process you want to run and when to kind of put some boundaries on it for your own sanity.
So as much as I would love to say that would work, it just feels like it takes the time it takes and that you have to go through that seemingly desert for months and months. I know that, brand name firms with really great performance, they can get that done. And they do get that done. This is going to be our final close, and it's within a few months, and they can fill their book. I'm sure Benchmark fills their book within 24 hours or something darn close to it. Unless you have rock star performance, my instinct is it's going to be the time it is. And the 30% that you got in month 18 likely would not have come in month 6.
All right. So the answer is just be Benchmark. I'll do that going forward. That's... But to that point, like I'm half joking, but I'm reminded of, I went to this like Q&A that you did at Camp Hustle 2024, which was great. And I remember a conversation coming up that was something to the effect of, and it reminded me of conversations that I have with founders sometimes, like at Pre-Seed Seed, where the conversation is, well, I can't get traction if I don't raise money from investors, but I can't raise money from investors without traction. What advice would you have for emerging managers who feel kind of chicken or the egg of, well, I can't really prove this out until I get some capital, but they can't get capital till they prove something out?
Yes. In a perfect world, I do think you need to have evidence that you're a good picker of companies. It depends on who you're going to get your capital from, right? So different LPs are looking for different things. High net worth individuals and smaller family offices, you might be able to get them over the hump with your background, and they'll take the leap of faith that you will figure out, you'll get access to the right companies and pick the right companies. When you start going to more institutional LPs, they need to see some proof that you can get into interesting companies. And it also gives you something interesting to talk about when you go to pitch your fund. It's not just, this is the space, this is my background, this is the space I'm investing in. It's like, and here's an example of a really great company that I've invested in. It could be a $10,000 check. It could be, it doesn't have to be your archetype of, I'm going to be investing $1 million in a company. You can just be $10,000 but the CEO needs to be a reference for you. And this idea, it's funny, a lot of emerging managers believe that they need to have brand name LPs come into their fund. And sure, that would be nice. But really is all you need to do in that first proof of concept fund is prove that you can find good companies and that you can access good companies. So if you need to raise all your money from your dentist and your uncle and, your long lost friend who's a professional football player, do it and prove that you have access to good companies and you can get great references from your CEOs. And then you can worry about, upgrading the quality of your investors in your next fund or your next fund. But it's a luxury to be able to have a diversified LP base, and it's a luxury to eventually get institutional investors.
Yeah. And I think to go back to something you said there of, evidence of good picking, good decision-making, good judgment. If you don't have any evidence of that whatsoever, it's probably reasonable to question yourself whether, should I be doing this? Like, should I be pursuing other people's money to put this to work? And sounds obvious, but there are all kinds of people who, because it sounds exciting, they decide they want to start a venture firm without necessarily having...
It's a fun job. It's a really fun and can be very lucrative career. And the barriers to entry to becoming a, pre-seed, seed stage investor are very low. You could come at it from so many different backgrounds. And so I do think being, really thoughtful about, am I a good picker of companies? And can I access these companies?
A conversation I've had with some emerging managers recently was around their boundaries for when to go outside their core focus for their fund. And some of them will have, say, a percentage where they'll define pretty clearly, this is what a core deal looks like for our strategy. And at least 80%, 90% needs to fit within this box. We'll give ourselves some leeway so long as it's not crazy outside of that. Do you have any thoughts on how tight emerging managers should be to that core thesis? And are you comfy with wiggle room? What does that look like?
So it's interesting. I mean, even the brand name firms will do that, right? And the way that LPs work is if you do something that generates really great returns going outside the box, then they're supportive of it. If you do something that loses a bunch of money, then they're not supportive of it. And so, the advice that we give to emerging managers is if you believe that this has outsized venture capital type returns, outsized performance, and you have a right to win to get into like the best company in that space, then I would do it. And the other thing I hate to say, I tell emerging managers too, is I wouldn't do those investments early in your deployment of funds. And the dirty little secret is if that outside of the four walls investment ends up being a massive success, then in your next fund, you say, I'm going to do more of those types of deals, and you widen your scope. If it ends up being a wipeout, then you do what all the brand name venture funds do. And when you do your track record, you take that one out to say it was off thesis for what you're going to be doing in your subsequent funds.
Yeah, I see why that's a dirty little secret. Yeah, I can see that. Yeah, for sure.
And the other dirty little secret is, SPVs are a hassle. They are hard to, it's like herding cats at the same time as trying to close a fund. And yet your economics there are on a deal by deal basis, which is always less risk as opposed to a commingled vehicle.
Do you think opportunity funds have a useful place for emerging managers? Or is that something that you should just use SPVs for if you can't put the money to work within the first fund that you have or the fund that you have?
So I will tell you, I've got two different perspectives on this. One is from the investor perspective and one is from the GP perspective. From the investor perspective, I do not like opportunity funds. They're normally very concentrated. If you really believed in these late stage opportunities, put them in your main fund. Make your main fund larger as opposed to, but no, you want to have the sizzle from the early stage positions in one fund and the 2x kind of return in the opportunity fund, and then you staple the two to make sure that I have to have exposure to both. If you believe you can create a 3x plus out of your opportunity fund, put it into your main fund. If I'm a GP, I would like to have two separate funds so that I could have different economics for the two different stages of investing. And it allows me to put additional money into my best companies. So that's where the rub is, right, between the GP and the LP. But I think most LPs are not huge fans of opportunity funds. And it usually is just the brand name funds the more established funds that can staple it and can get LPs forced to have to invest in both. I like SPVs.
I know plenty of VCs who started building AI into their process and different ways throughout their process, sourcing, picking, et cetera. Is that something you're seeing on the LP side as well?
I don't know the answer to that. I mean, we are using AI, but not the way that a lot of the venture managers that we work with are using it. We're just more hesitant. And I'd say LPs generally tend to be a more conservative bunch than early stage VCs.
I believe that.
And so I think my instinct is, it's just going to take a minute before folks that are more conservative start really implementing it. You also find LPs are not quite as tech savvy as most of the managers that we are investing in and supporting. We now have on our educational program, we have shared services that are for the managers that we work with. And we now have an AI specialist who's worked with a lot of brand name venture funds. And so she is helping emerging managers in our community figure out how to use AI both for managing, if they want to, managing their top of funnel for deal flow or using it for operations. So that is the thing, and it's happening. And we're looking forward to maybe eventually using some of those things, but maybe being a little bit more cautious about it.
Yeah. I mean, for me, it's helpful as a supplement on diligence and research, but it's less helpful when you're talking more at pre-seed than even seed. And I suppose if you're looking at fund one from an emerging manager, and there's not nearly as much data. And what you were talking about earlier of the art of getting information out of reference calls, that's the kind of thing just doesn't shine through in a deck that a model can pick up.
I think is where it would work is if I could clearly say, I only want to back venture capitalists that are raising funds under this size, over that size. I only want to back funds where the GP has, an electrical engineering background or the word AI is in their CV, but I don't invest that way. So it would be hard for me to create the characteristics that I would want to identify in a manager.
Is there something you've changed your mind about in a big way in the last few years?
I would say that I had more conviction in partnerships at the beginning of Recast than I do now. Two partners coming together. It's not that it can't work. It's just that there are issues that could happen. We talked about that earlier, but that evolved over the last 5 years. The other thing that has evolved is the brand name spinouts. I always knew the risks, but a lot of those risks, you need to have hunger to go at it for fundraising. You need to have hunger and drive to prove to yourself in the world that you're a good investor. And maybe you don't have that amount of drive if you've already been a general partner at Sequoia. Or maybe you don't have that level of drive. Some people do, but sometimes it's harder to come by.
Is there a go-to question, like your golden gun question that you like to ask emerging managers?
So my partner, Sarah, has one. She always wants to know what the vision is. Right now, you're a solo GP. Do you want to be a solo GP forever? Your fund size now is 30 million. Do you want to be 300 million or is 100 million the best option? She always asks that question and the answer matters to her dearly. For me, I figure you don't really know the answer to that question now. It's helpful, but if you're a bad investor, you're not going to be able to do that. You might decide over time that you find this great person that you want to be partners with, but so things change with time. And so as long as this is a great fund, I can make the decision on the next fund and the next fund at that time. If you start going off the rails, I'm okay with that as long as this fund I invested in was really strong. So it comes back to also every LP is different. And, one of the things piece of advice we always give is, figure out who you are as a firm, what your answers to all these questions are, what is your follow-on strategy, what's your portfolio construction strategy, and just find your people. And a no is a blessing. If you can get a fast no, that is a blessing. And just put down the proverbial phone and pick it back up again and find your people.
I think we've hit a couple of these, but what's a conventional view in venture that you think is bullshit?
Everyone says this, that you must put as much money as you can into your best investments. I don't understand that point of view. First of all, it all comes down to what size is your fund and how many investments you're going to make. So you're never going to have a cheaper valuation in a company than when you invest at the earliest stage, right? By definition, a successful company is going to have a higher valuation that you're going to be buying into. So you're going to take down your multiple in that investment because you're coming into later stage rounds. If you don't believe in the rest of your fund, then sure, do that. If you don't believe that you can't find other really fabulous early stage companies and you don't believe in your ability to do that, then sure, put it into that. But otherwise, Founder Collective, they never would invest in Series A, not ever. They said they wanted to be a signal they did not want to be a signal in market against their CEOs. And they could instead be alongside their CEOs and give them great advice. I'm not saying everyone should have that model. I'm not saying that at all. I'm just saying advising GPs that they should always put all their money after all their best companies. I just do not think that is the right answer for all GPs and all portfolios. I don't.
Courtney, I love this conversation. You're super thoughtful. You'd be an amazing LP to work with. If there's another GP out there who would like to work with you and more broadly with Recast, what's the best way for them to get on the Recast radar?
So we're totally accessible. LinkedIn, following Recast, following me is where you're going to get information about programming and initiatives that we are working on. It's the easiest way to, if you look at our LinkedIn feed, to figure out what the timing is and what efforts we're working on. Right now, we're going to be opening up applications soon for our next cohort, our 2026 cohort, so in a couple weeks. And then in addition, we are partnered with iBank for their SSBCI grant dollars. And so if you are an emerging manager in venture who is located, senior investment professional is located in California, and you are investing in the state of California, that program might be a good fit for you.
Cool. Well, look, thanks so much for coming on the show. This is great.
Thank you, Joe. It was a pleasure.
Thanks for listening to the show. We really appreciate the support and would love it if you'd subscribe to the podcast on iTunes, Spotify, your preferred podcast platform. One more thing. Investing in startups does not have sponsors, but I want to give a shout out to one of our portfolio companies, Micro One. Micro One helps businesses ranging from startups to enterprises to source world-class software engineers. Micro One uses their own AI tools to identify top 1% engineers and get them working for customers in as little as 48 hours. And if Micro One could help one of the largest AI companies in Silicon Valley hire 250 engineers in 30 days, they can probably help you too. If you'd like to learn more, visit microone.ai. And thanks for listening.
Joe Mager is the founder and managing partner of Seaplane Ventures. The content here is for informational purposes only and should not be construed as investment, legal, or tax advice. The opinions expressed by guests are their own and do not reflect the views of Seaplane Ventures. Our host, guests, and clients may hold investments discussed in this podcast. Please invest responsibly.